Hello everyone, a very good evening. You're watching The Money Show on ET Now's Rise with India Primetime segment. I'm Mubina Kabasi, and today we're going to be talking about the move that we've been witnessing in the equity markets. Plus, it's also, of course, the beginning of a brand new financial year, and I'm sure many of you may be using this opportunity to sort of give your mutual fund portfolio a relook, as you must do. We always advocate that you must give your mutual fund portfolio an annual review, even though you need it maybe for your retirement, maybe 10, 20, 30 years down the line. It's always a good idea to annually review your portfolio. But if you will review it, you will witness red on your screens. NAVs have been whacked out of shape. So in such a scenario, is rejigging your portfolio the best thing to do? Should you be selling or redeeming your units when the values are so low? I am joined by Harsh Roongta, personal finance expert, to talk about this and more. And of course, viewers, I hope and I'm hoping that all of you are staying safe, are staying at home, even if you're bored out of your minds. Well, here's an activity to do. Log on to CAMS, bring out your mutual fund statement, and you can take a look at whether your portfolio needs to be reviewed. You can do so on our Ask the Money Show segment. We'll kickstart in just minutes from now. So, Mr. Roongta, always a pleasure having you with us on the Money Show. You know, this is a time when people are not just seeing their NAVs being whacked out of shape, but many of them may also be facing a cash crunch of sorts. We even had the government saying, look, you know what, if you're really having problems, don't pay your EMIs for 3 months, we'll allow it. Plus, they're also saying if it's really, really bad, then maybe tap into your retirement piggy bank. That's the Provident Fund as well. A certain amount can be withdrawn from your retirement piggy bank. So, Mr. Roongta, in such a scenario, when your NAVs are anyway down, when one does not want to touch their retirement kit, what should one do if they need money? I mean, how should one essentially plan their finances in the time of coronavirus?
Well, I think it is planning that comes in useful when you have unexpected events like the coronavirus. And I think more than what you should do, it is important what you should not do. So let me concentrate on some of the things that you should not do. And let's divide them up into people whose cash flows are going to be impacted. Those would be, self-employed people who are going to really see cash flows impacted. Even salaried, I mean, we are going to see salary delays. We are going to see job losses, unfortunately. So, that is one. Then there would be a class of people for whom the cash flow is not going to be impacted. So what are the things they ought not to do? First, I think both classes should never take any step in a panic or as a knee-jerk reaction. And don't pull out of your existing equity, whether it is direct equity or mutual fund equity schemes, just because they are in a loss. As you rightly said, it's going to be awash with red right now, but don't pull out of it simply because it is in a loss. Don't stop SIPs in an existing equity mutual fund unless there is a cash flow issue. I mean, if the cash flows are in a danger or they are already impacted, then obviously you may have no choice but to stop the SIPs. But otherwise, do not stop the SIPs into equity mutual fund. You can use the emergency fund. So if you have done planning well, you would have a small little emergency fund equal to 3 to 6 months of expenditure. Use that rather than use the moratorium that I think we were speaking about in the earlier program. Very clearly, the moratorium comes at a cost. So by all means, if you are those whose cash flow is impacted, use the moratorium. But if your cash flow is not impacted, it's much better for you to, pay it from your cash flows or, use the emergency fund if you have it. One quick point is never ever use the credit card moratorium. It comes at usurious rates. Again, very important thing to remember in terms of doing is insurance before investment. So I think all your term insurance premiums, health insurance premiums, car insurance, property insurance. Make sure that when the debit hits your account, there is enough money, or that you pay those premiums. Very, very important to keep your insurance premiums up to date. And I'm not talking about the insurance cum investment policies. I'm talking of the pure insurance policies. One thing that again you can do, that if you are in the middle of shifting money systematically monthly from debt funds into equity funds, then maybe you can, I mean, that shows that you are surplus on cash. Then clearly this could be an opportunity to accelerate that shift. Instead of say doing it over the next 15, 12, 15, 18 months, you could probably do it over the next 12, 15, 18 weeks rather than months. So my point is, do everything based on a considered review rather than acting in a knee-jerk fashion.
Okay, understood. Well, Mr. Roongta, when we had you during our Christmas special as well, you had mentioned that one of the resolutions of sorts that everybody should take was keep an emergency fund that would be worth a certain amount, that would be dependent on your monthly expenses, and then multiply that monthly expense by 6 or by 8. So if our viewers had listened to you then, they would have been kind of okay right now. Now, Mr. Roongta, I want to talk to you about the bit that I mentioned. A lot of our viewers tend to look at their portfolios at the end of a financial year or at the beginning of the financial year. They look at their NAVs, they fall in, etc. But, again, you have to ensure that your mutual fund portfolio aligns with your goals. So let's say something has come up and you need the money, say, next year, which means you have to put certain money in debt funds or whatever rejigging you have to do. Given how markets are right now, given how NAVs as well are right now, a retail investor cannot time the market. So would you advise them to postpone any sort of mutual fund portfolio review they may have scheduled for doing around this time?
I mean, I think you should have a fixed review date. And even taking the use case that you just mentioned about, say, a goal falling due in a year's time, typically if you have done your planning well, that the money that is needed for the goal that is due just 1 year from now should have started slowly tapering into debt. You should have slowly systematically shifted it into debt. In fact, I have a specific client who had saved enough money for his son's college education in UK. It is going to be in August. By last November, when his admission got confirmed, we had already started tapering the amount. And because of that, today, most of that money is sitting in liquid funds, and even the balance is in very, very low equity hybrid funds, because that is how it was designed. So the point is that if you plan it properly, then there is nothing that you need to change. Coming to the fact of what should be a review, I think you should have a fixed review date. It can be the beginning of a fiscal, it can be your birthday, spouse's birthday, anniversary, child's birthday. But an event like the coronavirus, definitely I think that calls for a review. I think what happens as a result of that review is something that is different, because the review will obviously, at the time of review, you are not just going to be looking at your how much is fixed income, how much is equity, etc. You are also going to look at how stable are your cash flows, are you likely to be having those cash flows in the future. I think all those factors will be important. But if your cash flows are stable and your equity has fallen because of an event like corona, then maybe it is an occasion, a review, a mid-term review, if you may. It may be an occasion for you to up the equity component systematically. Never lump sum, systematically you can up the equity if your cash flows are steady.
Okay, understood. What about debt, Mr. Roongta? Because that too is an equally important part of a portfolio. Now, many of our retail investors may not be familiar with the jargons associated with debt, but there have been several announcements come by from the RBI that could provide some good money-making opportunities over there as well. What's your advice on that front?
So again, I am assuming that for the people who are watching this program, they are not seasoned investors. So money making opportunity and debt, I would say, please, for a lay investor, don't try to make money off debt funds. I think debt funds typically would be advised for goals that are due in the next 1 or 2 years, or for senior citizens who are seeking to get a monthly, a regular payout from the debt fund. I think that is the constituency to which I am addressing this answer. There, I think if you have a goal that's going to be due in a year, year and a half, 2 years, then you're talking really of liquid funds, bank fixed deposits, and the like. Literally, I think that should be where you should be investing. But if you're, say, a senior citizen and you've used up things like the senior citizen plan, and if you were fortunate enough and if you have before 31st March used up the PMY Vandana Yojana, all that is over. And you still have funds from which you expect a monthly return, then you could look at funds like the banking and PSU debt funds, or say the Bharat Bond, which is a PSU debt fund, Bharat Bond FOF, the 2023 one. There is one 2023 and one 2030. I would recommend the 2023 one. Now, it is not that these fund values, the NAVs, will not go up and down. They could go down if interest rates rise. But if you want to withdraw from them over 5, 8 or even longer years, if you want to systematically withdraw, then I think these are a good thing where the credit risk is very, very low. The chance that one of the issuers will default is very low because this money is lent to banks and to PSU debt funds. Although, I mean, banking and PSU debt funds did have 81 kind of bonds as well. But I think the lessons have been learned there. So I think those are things that they could definitely look at. And, but for that constituency alone.
Okay, all right. Very quickly, I want to sort of move on to some of the viewer queries we have been getting. We've been getting a plethora of them, folks. We'll try our best to answer each one of them. Neeraj Kumar Bhatt writes into us saying, I'm a government servant, 30 years old. I've got health insurance, a 1 crore term insurance, monthly NPS contribution as well because of being in a government job, a PPF account where he parks some money wherever there's elbow room. He invests in 2 ELSS funds, AB tax relief and Axis long term, SBI blue chip, HDFC mid cap, SBI small cap, all of them monthly SIPs. He is obviously a long term investor and he wants to know if he must continue with the same funds, keeping the corona mayhem in mind. Should he add or subtract any funds? So it's a mix, blue chip, mid cap, small caps into ELSS. Mr. Roongta, your advice?
I think very sorted out investor. See, he's a government servant, so cash flows are relatively stable. Okay, but if you look at his investments, they are very, very debt heavy. Even NPS for government servants is 85% debt. Unless I think they were to relax it. I don't know whether that has happened. And he's parking it in PPF. The good thing is that he's making 13,000 rupees investment on a monthly basis in these 2 ELSS, 1 large cap, 1 mid cap, small cap, so well balanced. And this will do him well. I mean, the 13,000 rupees SIP, if he continues for the next 30 years, he's only 30 years old, it will give him a pension inflation adjusted of roughly 21,000 rupees per month in today's money. So that's a fair bit of second pension that he would be getting apart from what he gets from the NPS. The word of advice for him is, I think for the amount that he is investing, the funds are good. The 3 funds that he has, the 2 ELSS that he has are good, I would suggest he should consolidate. As far as the ELSS is concerned, among the two, whichever one he wants, he can choose and have only one. And instead of the three separate funds, he has a large cap, mid cap, and a small cap. I would advise him strongly to do a Nifty 500 fund. Currently, I think only Motilal Oswal is offering a Nifty 500 index fund. That's what I would recommend. So it becomes very simple. One ELSS and one Nifty 500 fund. And that is it. And that gives him exposure, which is very large cap oriented, but gives him mid cap and small cap as well.
Sure. Correct. Okay, understood. All right. Thanks so much, Mr. Roongta. Unfortunately, we're out of time on this episode. We'd love to take more queries, but thank you for joining in.